Okay, so if it's true, you have to explain, you don't have to explain. But if it's false, you have to explain why it's false. And then there's gonna be like 5 questions that are kind of short questions, and then 3 questions, they're a little bit longer. So it shouldn't take you more than 3 hours max, maybe 2 hours-ish, to get the whole thing done. Remember, especially for the longer questions and even the short questions, I tend to be one of those professors that don't really believe in absolute yes or no answers, except for example, if I'm asking you how to convert, um, pre and post money, right? Percentages, right? Those could be absolute answers. But if it's something like calculate TAM, SAM, and SOM, or something like that, right? Those are more based on rationale and how you thought through that process. That could be wrong, right? So remember to add your sources and be very, very clear on how you came to your conclusion. Usually, most of my grading, you get partial points. So if you're able to land on the wrong answer, but your reasoning is pretty sound, you can still get a decent amount of points that way. I'll have a review for tomorrow. Since we're a little bit ahead, we could make the second half of the class tomorrow, for the midterm review. So keep that in mind. Any questions about the midterm? So I'll post the midterm's going to go live on Sunday, and then you'll have all the way until Thursday to answer the questions. Any questions about the midterm?
Will we also have homework in addition to the midterm?
Do you guys have homework that week?
No, okay. No, I'm just wondering.
Unless you guys want homework. You guys want some homework?
I mean, now that you mention it.
You
Okay.
right? I mean, you guys are the ones that would actually do a Friday summer, 6 o'clock class. So you never know, All right. So I'm gonna take that as a no. No homework lie. Okay. Anything else? This is an individual project or individual midterm, by the way, guys. It's not a group midterm, just FYI. We good? Okay.
good.
Cool. So yeah, we're gonna oh yeah, graduation. Someone mentioned that the graduation time has gotten pushed to an earlier time, so it shouldn't affect the class schedule for this particular class. Is that correct, guys, or do we need to still go at the 4 o'clock time? I think it's like what, late July. When was that date? Do we? Yeah. So if you guys wanted to clarify that, now would be a good time.
I think I'm graduating August 6th, though. I don't even think this really applies to me.
Okay. MBAs, do we have to adjust here? Or are we good? We're good, right? So we could stick with the 6 o'clock? Okay. Perfect. Cool. So yeah, let's talk about the homework. I thought this exercise was really fun. It was an add-on, right, to the sim that you guys did. And the exercise was to imagine if you were offering a term sheet to this company, right? And we're gonna kind of go over the homework. Do we have any volunteers, or should we spin the wheel? Spin? Okay, we'll spin. Okay, so not everyone's here, but since this was a group project, we should get some folks. Okay, Luke. Luke is not here, right? Oh, Luke is not here. Okay. We'll just bring him. Oh, Logan.
Yes, sir.
Okay. Do you want to share your screen?
Yeah, of course. One second. Let me just pull up the old file.
And guys, this is a great time to debate, what some aspects you agree or disagree. I've always wanted to do kind of like a scenario where, VCs and an entrepreneur would negotiate terms, but because of COVID, we never was able to do that. Oh, there it is. Cool.
All
But
right, can everybody see that?
yeah.
All right, cool. So what exactly would you like, what would you like us to run over?
So let's start with, let's just kind of go over the pre-money valuation super quick. And then, what are the terms that, let's say, were the most important to you guys? And what were the terms that you felt that had room for negotiation, and the reasonings behind both those scenarios?
Okay, for sure. So I guess we're just going to start with the pre-money valuation. That's fine with me. We just assume that for the pre-money valuation, we would choose the number that we got from the Excel spreadsheet, like I guess the overall value of the company, then that was excluding the investment that we were going to put into it. So that was 9,076,000. If you want to also talk post money, we added that 3 million into it, ended up with 12,076,000 for the post money, which would have given us roughly 25% ownership in the company.
So why did you guys want 25%?
That was just a number that we felt like seemed to be adequate, like kind of at least relatively on par with everything else that we were finding online for how much ownership a VC should have.
Okay. I have a follow-on question, but I continue
Sure.
on there. Yeah.
Oh, all right. So Vince, do you think there's any specific things that, we should talk about? Like probably the employee option pool would be a good one to discuss, 15% valued at pre-money.
Yeah, let's see. So, well, overall, our strategy was kind of to continue letting the CIM software company just continue operating, because it seemed like it was growing. It was, doing pretty well on its own. So, we didn't want to interfere too much, but we did at least want to get that, 25% in there. And then so while giving them a certain degree of control, we also wanted to just try to dilute some of the founders' stocks a little bit by doing let's say like a pre-money pool, employee option pool. So that way 15% is going to be offered pre-money, and then that's going to also help in the employee retention too, as the employees can, the key employees can continue to, they can purchase stocks. And after we just followed the normal 25% vesting at the end of each year. And so it was just kind of important to us that we can just continue keeping everyone on board while the company continues to grow.
Also, something that we thought would be important would be the board structure. So I think as of right now, CIM only operates as they have a CEO and a COO. They also have a CTO, but I don't think he technically like sits on the board or anything. Like he's just an employee. But we figured that, we would like to have 5 members on the board. So 3 of which would be comprised of people that actually work for CIM. So that would be the CEO, the COO, and realistically the CTO is what we figured would be like, fair. And then also 2 representatives from our VC team, S&V Venture Capital. So we were just, throwing out hypothetically that could be Vince and myself would be placed onto the board. That way we could have like some more interactions with like daily operations and things such as that. That just seemed fair to us to have like our, our nose into the say of what gets done and what doesn't. Then I would have to say, what would be another important clause to mention?
Oh yeah. So another thing was the dividends. So they were paying a lot of dividends out before. we at first were thinking maybe we shouldn't give them any, allow them to do any dividends as it's a VC deal and everything. And it's, we really want it to grow, but we thought, we would just lower the amount that they could pay out just to kind of encourage them to continue continue doing what they're currently doing. And then instead of, we added, just to, as like a bargaining chip kind of just, we also added if the revenue continues growing, they forecasted they would grow by 24% in the year 2021. So we just threw that in. If they do that, then they can, receive dividend at the rate of 4 to 6% of the original purchase price.
They're such nice VCs.
Yeah, we figured it would be a good idea to try to keep them happy, at least initially. And also there's more room for negotiations. Like, I know this might seem a little bit, off frame or something like that, but I originally thought that the CEO could have been dropped just because, he's essentially in charge of the division that actually takes care of things like, the dividend payouts. And I'm like, I feel like his expertise may not be as useful as the COO's because the COO works with the technology division. So it'd be better to keep him on. And then like what you could do is have a new CEO come in and just kind of help shape the direction of the company in which way that you want it to be going. But we figured if we wanted a deal to actually go through, incentivizing the CEO to stay on and the COO to stay on through, those, albeit, I mean, they are dividend payouts, but they're heavily reduced in comparison to what they should be, probably would be a good way to go.
Quick question, just quick pause here.
Mhm.
Okay, if you guys were to remove or want to remove or have the option to remove the CEO, how would you restructure and repackage this offer if that was a priority?
If it was a priority to get him kicked off,
Mhm.
hmm,
And anyone can chime in here.
We could try to just take control of the board, have an extra seat for ourselves. Like what Logan was saying, we were thinking about just trying to get that majority, but it's just that they've been growing and everything. Maybe we could grow it, even faster, even more aggressively. But yeah, that was kind of why we were saying that maybe it's fine to just leave them, have that control and everything. Pretty sure we're not the only VC that they're, probably looking at or anything. So just trying to make a deal that looks attractive to them.
What's another approach you could use?
it's also possible that you could drop the board member seats from the 5 that we have it set to right now down to 3. So that way you could have the CEO, the COO come on. You could also have the CTO, push in, or better yet, you just get a different CEO altogether that the VC approves of. And then I guess you could put yourself into there.
Yep. And you could also structure this as a PE deal, right? From the very get-go, just buy a majority ownership of the company and then kick out any executives that you wouldn't want.
Yeah.
Right, from the very get-go. That's great. Keep going. This is awesome.
All right. Is there
Liquidation preference.
liquidation preference?
Yeah.
So if I'm being 100% honest, I'm still a little shaky as to what a couple of these definitions are. For example, the anti-dilution and the liquidation preferences, but I'll try to explain it to the best of my ability as to what we have up there right now. So if something were to happen to the company in the event where it's like, you're going to have a mass liquidation or a liquidation event of any kind, preferred or holders of the Series A preferred stock, they're going to be entitled to receive the equal value of their preferred shares, plus any dividends that have that are unpaid to them, but have been declared. So that just seemed like, pretty standard run of the mill deal according to the book and everything else we were finding online. So we're like, that seems like a good approach for that. And then underneath that, we also went with the clause where we wrote, after the payment of the liquidation preference to the shareholders of a Series A preferred, the remaining assets shall be distributed ratably to the holders of common stock and Series A preferred on common equivalent basis, which I took to mean essentially is, you would get your initial investment back, like us as the investors, we put in the 3 million. So we would be promised that back. And then plus our percentage ownership of the company in the case or in the event that it would sell, we would get the percent of whatever those assets left over would be, we would receive that percentage, if that makes any sense. That's how I interpreted it from the book. Like,
Yeah, I think you're definitely on the right track. So did anyone have a different liquidation preference multiple? Lie? What did you have and why?
I know the average was ×1, but I put ×3 because I was the investor and I'm greedy.
Yeah, I like it. We should do business together, Lie. Yeah, these terms are too nice. So basically, Logan, you're on the right track. Just think about it this way, right? So if you are a entrepreneur and you raise money at a $10 million valuation, if a VC has a 3x liquidation preference, right? And the VC invested at least $5 million, right? To put your post-money valuation at $15 million. What do you need to do, right? If the VC had something like a 3x liquidation preference? And we're just thinking like one investor.
I mean,
VC 3x liquid. So basically it means the VC has to make 3 times more his or her money before you as a founder gets paid out, right?
oh, I
That's
see.
in simple terms.
Yes.
So what's the valuation you need to exit at for you as a founder to actually even make any money, to get a sniff of the profits?
And in our case, wouldn't that be?
Not your case. If a VC invested 5 million, right?
Yeah.
Let's just say we're trying to simplify it as simple as possible. And this is open for the whole class. 5 million, right? A VC invested, 3x liquidation preference, right? But the post-money valuation is 15, right? So 5 times 3, 15, you add it to the post-money. So you got to exit at least 30 million, right? For all the VCs to, make their money. This is simple math. Like there could be some other dilution when it's like getting really complicated, but that's what the liquidation preference is. So you as an entrepreneur, you want the liquidation as low as possible. And what's fascinating is that during the dot-com bubble, it wasn't uncommon to see 10x liquidation preferences at the time, because people were just throwing money into the internet. And then in order for them to get like VC funding with like no traction whatsoever, it's like you just bought a domain website and you're asking for like a $20 million valuation. I want a 10x liquidation preference. Oh, okay. You sign the docs. It was not uncommon. So you would see 2, 3, 5x liquidation preference. But yeah, thanks for chiming in, Lai. So keep going, Logan.
Now having this information, 2.5x. I changed my mind.
Keep going. So liquidation preference and go up a little bit.
Yeah. Anything in particular that?
Dividends. Yeah, let's go over anti-dilution.
Great. This was the section I understood. Like I understand it in a general sense of what it's supposed to do, but this one was a little difficult for me to fully grasp as a concept. So maybe Vince wants to jump in. Help me out.
Yeah. So they had a full ratchet adjustment, or they had weighted average that we saw. We thought that weighted average was from what we read. Also, it's the founders as well as early investors might prefer a weighted average. I also wasn't too sure about it, but basically, in the event that more investors, Series B financing come in, then the average stock price, I think kind of stumbling over words. I'm not even too sure how to explain. So at a purchase price less than the applicable, oh wait, that's the conversion price.
But is this anti-dilution for you guys or the founders?
This is for us, yeah.
Okay.
Yeah.
Okay. Gotcha.
But if the stock prices if the stocks were sold at lower cost than what we paid at first, then it would be the weighted average. If it's bought for higher, then it would, increase the value of ours too then. So that's kind of why we went with the weighted average. And it just felt safer too, since this is only Series A financing. That's also why we wanted to go with that.
Interesting. Did anyone else have an anti-dilution clause as an investor? No? Okay. Yeah, interesting. It's not typical to have it, but I mean, it doesn't hurt to ask, especially when you only ask for a 1% or 1x liquidation preference. So like it kind of balances out. It could have been a strategy, right? So it's like, oh, we can't do the anti-dilution. Well, they're going to do 2x liquidation preference. It's like, well, we don't want to give you that. All right, fine. Well, we're going to like lower this to 6 million valuation. I mean, there's a lot of things you can do here. Great. Key person clause.
So the key person clause, we essentially wrote it in the instance that, you know, somebody who's key or vital to the operations of the business in case of, how did I frame it exactly? I believe it was in the event that a board member perishes, becomes incapacitated, or fails to execute in an effective manner over a prolonged period of time, SV, or I would assume that's a Cypress, Cypress and Bizak, excuse me, by. Am I totally butchering your last name? I apologize. My bad, my man. In the event that that happens, we have the right to postpone or release the board member post discussion with the other board members. So like, obviously our decision is going to be final at the end of the day, but we still, before we make that deal come to fruition, we would like to talk to the other board members to see how they feel about it, just to get like a general sense of the room, or like the general vibe, if that makes any sense. And hypothetically, if the employee or the person, you know, that's vital to the success of the operations has to get fired or removed, we issued there's going to be a 180-day period to find a new comparable replacement for said person.
So this is saying all key management determined by the purchaser as it shall be approved by. Okay, so you're basically saying any C-level executives that are being hired needs to be approved by the board, right? Is that
Yes.
the correct? Okay, good.
Yeah.
Good. Okay, that's good. Conditions.
To keep going, conditions to closing. So yeah, just subject to board approval by the acquirer, which is us. So same thing that you kind of just said. And then it was also subject to due diligence / agreement on definitive documents. So that could be essentially any of the deals that we're working on right now, the negotiations, like, you know, the closing statements, or I mean, even the final terms, you know, those are all subject to, I guess, scrutiny, or, you know, come to fruition, agreement from both parties, if that makes any sense.
Mhm. Did anyone get a little fancy on the conditions to closing? Any, for example, like working capital needs, or, you know, code verification? No? Okay. Good. Keep going.
And then we had a right of first sale offer and co-sale agreement. If I'm not mistaken, this is essentially that founders, they're not going to be able to sell, like if they're a major contributor, or like they have a majority share, if I remember correctly, are not able to sell, transfer, exchange the stock unless each investor has an opportunity to participate in the sale on a pro rata basis. So basically that means if you have, you know, majority share and you want to sell out, like you're not able to sell out immediately, effectively bankrupting or potentially causing a lot of issues for the company. And then we had the no shop agreement. And this essentially was like, hey, don't go around. If we're in negotiations with one another, you can't be accepting offers from other companies, at least while the negotiations are ongoing. And yeah, I mean,
Let's go over the summary of offer. Go down a little bit, Sam.
oh, I thought this is essentially what we were doing right now. We were just,
Going over that. Okay.
Yeah.
Any questions, any comments about some of these terms, if they look a little bit different from yours? No questions? Okay. If you guys were company sim number one, would you like these terms, or would you not like these terms? And what would you like and dislike as an entrepreneur? Where would you like even, what would you try to negotiate?
I would negotiate valuation for sure, but other terms are good, are reasonable. Yeah.
What else? Valuation, like Priya, what kind of valuation you want?
At least 18.
At least 18?
Yeah.
How would you justify it, by the way?
By our revenue, our profit, our growth potential. So, yeah, I think they deserve 18. Yeah.
Okay, at least 18 million. Good. Anyone else? What about the stock option pool? Go down. Pre and post. As an entrepreneur, do you like this or do you not like this?
Basically, I think it's a lot, but so valuation is low. So if the valuation goes higher, you can just set it not by percentage, by like dollars, So you can say like we have like this much employee and we want to like make it $2 million for full option. But basically you will dilute it. So you don't want it, but I think you don't have any choice, because it's necessary.
But what about pre versus post? Did anyone catch that one? What's the difference between getting stock options pre versus stock options post?
Yeah, so as just I explained it to you, when you have it pre, just the founders will dilute it. The founders share diluted. When you have post money valuation, all investors will dilute it with stock option.
Very good. So you're basically saying, well, if I just increase the valuation, what difference does it make? Right? Good. Scroll down. Like, okay, what about vesting? Do you like this or no? As an entrepreneur? Is it fair? Is it not fair? Any thoughts? 4-year vest, 1-year cliff. So let's kind of switch things around. Let's say you're actually acquired by another startup. Would you be excited about a 4-year vest and a 1-year cliff? Lie.
I would say with no, because I want, like, in case the company does go downhill, I want to have the option to get out as soon as possible.
That's smart. Yes. So this is pretty common, right? So if you're getting VC money, 4-year, vest, it's now this term sheet actually is a little bit ambiguous. Sorry, Logan and Vince. It doesn't say if it's gonna revest. So are you trying to say it starts all over again and you're at like year 0 again as a founder because you received this money? Or is it just a continuation from like, maybe this is like year 2, right? And you have to do 2 more years because you're honoring the 4-year vesting schedule, right? So that could be a situation where you have to probably clarify a little bit more. But ultimately, what this comes down to is that, like, if you're a founder and you're exiting, you want the vesting period as short as possible. Has anyone ever heard of the term vest in peace? So basically, when you sell your company to one of these big companies, right, like a Google, Facebook, Twitter, and stuff like that, for like 100 million, you're just kind of you're vesting in peace. You're basically taking vacation to honor your 2, 3, 4, or 5 years of vesting period until the company until the company like stabilizes, the new acquired company. But during this time, you're not really working. You're just kind of a figurehead and you're just like partying along. So that's kind of what happened to my friend Jason, who sold his company Caviar to Square for 90 million. Like, he just traveled the world for like 3 years and then Square just IPO'd and then he just rang the bell and everything. There wasn't much work that he had to do because he was literally vesting in peace. So that's pretty interesting. Normally what happens in this clause is that there's an acceleration clause. So if you get sold, then you could get all your equity vested for that time period. But what happens is that to offset that key man risk, sometimes when you get acquired, you have to revest. So one of my friends, he's a couple decades older, but he was the 29th employee of Fandango. And when Fandango got acquired by Comcast, there was a 10-year freaking vesting period. So from 2008 to 2018, he had to work at Fandango to make all of his money for shitty ass Comcast stock. But it still added up to like $600,000. So he as the 29th employee of Fandango, he stayed all 10 years to make every single penny, right? So that could also be very interesting when you know you know when you get an offer as an employee. Like let's say you guys join a startup and you get offered, you know, because you're like the VP of operations or, you know, finance or something like that. When you get offered an opportunity to work there, but you need to stay X amount of years to get all your stock options, I guess, like vested. Anything else you guys want to talk about for this term sheet? Okay, great. Let's give Logan and Vince a round of applause. Good job, guys. It's pretty solid. We'll do one more and then we'll talk about how I would structure this. Okay, so let's ask the wheel who's up next. Unless, do we have a volunteer? Does anyone want to volunteer?
Spin the wheel.
Okay, wheel time. Dun, 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 dun. Oh, the suspense. Ahmad. Did you go last week? Okay, let's see it.
Yes, we will present it, me and Puya. Puya, do you want to take the control of the screen?
Yeah, okay, I can share.
Oh, like
yeah.
it.
So you see we have $18 million of post-money pre-money valuation. We will invest $6 million and we will have 25% ownership. And the reason that I want 25% is just I figure out like I have $100 million cash liquid available to invest, and for this company I wouldn't invest more than 25%. Basically, this is my thought. So we changed our enterprise value to EBITDA because it was too high. As you told us, the company is not in earliest stage. They are like in maturity. So we decrease it to 12 to better reflect the business stage. And this is how $18 million came from. And so for security issued, we will pay $6 million in cash, and we will buy 25% as Series A preferred shares. For the option pool, we want a $2 million option pool to justify the employee incentives for hiring new employee. And I think the company already doesn't have option pool. So it would be 7.5% after dilution for the option pool. And for vesting and cliff, so basically we will have a 4 years for option pool vesting with a 1 year cliff. That means they cannot exit the employees. If they exit before 1 year, they wouldn't get anything. And for entrepreneur, we thought that it's fair to them to give them 1 year credit. So they will have 25% of their shares. They can have it, but after that it will vest after closing. It will vest for remaining three years monthly. And also I forget to say that the employees, they will vest quarterly, so we can manage better, you know. So if they like leave before, like the quarter, they wouldn't get anything too. And so for mergers and acquisition, mergers, especially double trigger acceleration, yeah, will be executed, yeah, for vesting a schedule, yeah, to just make sure that we are in good terms. For the board size, because the company is just raising money, I believe it's their first time. So we thought that 3 board member would be enough. And so the 2 founders and one of our representative should basically have the 3 board seats.
Wait a second. Go back. So the board shall be composed of investor, founder 1, and founder 2. Okay, let's take a pause here. Anyone questioning that structure?
Yeah, I can question that. So basically we mean that the founder 1 and founder 2 will have the option to select the board, you know, the voting right to select 2 board members, and we will have the option to select the 3rd one. Yeah. So it's not like necessary that they have to be a board member.
Okay.
Yeah.
Let's go back one more too. This is a good time to pause. Key employee retention. What do you guys like about this and perhaps not like about this? By the way, can you explain double trigger acceleration real quick, Puya?
It's too hard, you know, it's just it's just a protection.
Okay.
Yeah, I know that it would be beneficial for us, you know, in case of mergers. Yeah.
Yes. So it is accelerant, right? In the
Yeah.
case of a merger. Okay. What do you guys like about this? What do you guys not like about this? As well as a stock option pool. Go up just a tad bit more. Yeah, there you go. Any thoughts, guys? Let's think about it from an entrepreneur. Like, what's good about these terms so far?
I like that it's a flat 2 million option pool and it's not percentage. So if they manage to negotiate the post and pre-valuation even higher, then it won't be affected.
What about the quarterly vesting? Would you like that or not like that? Or does it not really matter too much?
We basically want to our
Wait, wait,
employees think
Wait,
long
wait,
term.
this is for the rest of the team. Just
Okay.
yeah. What do you guys like? What do you guys not like? Or does it not even matter? What do you guys typically see in a vesting schedule? Is it normally quarterly or is it monthly? Monthly, right? So I guess, like, you know, if you're a founder, if I was in this case, like, I would kind of question why you wanted it quarterly versus monthly when it's typical to have it monthly. So Puya, why don't you explain this part?
Yeah, so for founders, it's monthly, but for employees, is quarterly. And we know that founders will think long-term growth. And if I run the company, if I have like shares in the company, I want to every employees think long-term rather than short-term. So any action that they have, any value that they want to add, it should be in respect of growth in long-term, not short-term.
Okay, that's an interesting point of view. There's no right or wrong. That's great. So let's scroll down under board structure. Nice, liquidation preference. Okay, you're at 1x as well.
Yeah. So we have 1x liquidation preference and fully participation right. So I think it's not fair to founders that we will have like 2, 3, or more than 1. But when you have like, when you have 1 liquidation preference, in case of bankruptcy, we don't want to like, it wouldn't be fair. So if the company like valued as, I don't know, $10 million, so they wouldn't get anything, you know? So it wouldn't be fair. But when we have like participation right, after we take our, there are many cases. So if there is a case that we can just take our initial investment, and after that we can divide the rest between the common shares and us. So we can convert our preferred shares to common and like divide the money between us. Yeah.
Okay.
Yeah. And yeah, so for redemption, yeah. So basically we want a redemption on the beginning of 5th anniversary of the closing. In case the company couldn't make it to go public, you know, we want to exit way, you know, in like worst case scenario.
Good. I like that.
Yeah.
Good. Good
And,
add
yeah.
up.
And for dividends, actually, I just add this. We can just negotiate. So it's not a big deal for us. We just you can negotiate if you're founder. So we want the Series A preferred should receive their dividends in preference, and the dividends common stock at the rate of 10%. So it's a little high, I know, 10% maybe. But basically it's negotiable, so it can go lower, maybe 8-7%. Yeah. And from here, Ahmed, do you want to?
Yeah, this part about this clause about anti-dilution. Here we try. I will like explain it in my word. I have my note here. The investor trying to protect their share in the company in the future, like Series B or C, so their like share should not be diluted. This is what this clause about. And the next one, Cayman clause. Yeah, this one about the when the company want to replace the CFO or the manager, this manager should be approved from the board, and like what the previous group said, we have to like interview him and see what's we will like invest and what's the vibe and what he like feel about and this stuff. Condition to closing. What I understand from the book, this about be carefully reviewing all the documents and the claim by the founders and or entrepreneurial entity. And if we found something, for example, not true, there is no deal after that. The next one, right? Or yeah, I was asking Puya about this one. Actually, we didn't find anything like or clear like perspective about this one in the book.
Yeah, I think I remember from the class, it's just basically in case of companies like progress and like good growth, we have the first right to like invest in the company. You know, we can like double down, right? I think, yeah, it's just we have like priority compared to other investors. Yeah, so yeah, we have the right of first offer.
Yeah. The next one, co-sale agreement. I said that if the founder wants to sell a company stock, I mean cashing the stocks, VC can also say sell the same number of the stocks. When they sell, we will sell. We will be equal. And why we do this? Because we're trying to prevent manager number from turning large profit on their sale and leaving any liabilities to the investors. I mean, avoiding have like too much liability in the future for the investors of VC, I mean. No shop agreement. Yeah, we almost have same the concept from the previous group. So we put this clause to make sure that entrepreneurial entity will not like shopping around or like have something like deal under the table. So we have been like working hard with them. So we want them to work with us. And the last one, I think Puya, you did this one, right?
Yeah, it just basically says our voting rights is equal to common stock right. Yeah.
Yeah.
Gotcha. Is that it? Is there more? Oh, okay,
Yeah.
perfect.
The
So let's-
summary is almost same.
Here's a summary.
Gotcha. So let's review that second part. Go up a little bit. Okay. Liquidation preference, we already talked about that, so I'm not going to harp on that too much. Anti-dilution, this is great if you can get a key man clause, more or less the same. Right of first refusal or right of first offer. Okay. Anyone have any thoughts on the no shop agreement being 90 days? Anyone think it's too long? Logan.
Yeah, I was going to say, I thought the average was like 45 to 60 days. So extending it out an additional month was like, oh, we're in the long run for this one.
Yeah. So I would, if I was in this situation, I'd probably shoot for like 30 days if I had capital ready to deploy. But that's, tomato, right? Like however you want to structure it. There are also like what they call exploding terms where it's like, 7 days, sign this agreement, et cetera. Like competition get really fierce. So you're going to see this in the Justin Khan videos later tonight. He'll talk about some of that stuff when he almost sold to Google before when he was trying to sell Twitch. So that's going to be pretty interesting if you guys once you guys get a chance to take a look at that. Okay, so let's scroll up a little bit, and I'll just kind of go over, what I think I would do. Go up a little bit. Yeah, go up. So pre-money valuation, you guys saw the valuation. Option pool, as long as it's pre-money, I'm okay. Post-money, I'm okay too. I'm not like too much of a stickler on 10%. I don't mind giving the founders a generous option pool as long as I have the key man clause to hedge against what kind of C-levels that they're going to hire. As long as that's buffered, it's not a make or break. However, a make or break is the board structure. I would go for 2 board members from my VC fund versus they're just one co-founder. I want to have more control of the situation. And this might be a bias because as a former entrepreneur, like I have higher expectations. So sometimes when you work with VCs and investors, there's 2 kinds of investors. There's one that are just like filthy rich, right? And it's maybe generational wealth, or they've only worked in finance for X amount of years, never been an operator. So whether you're in PE or VC, or whether you're asking money from your aunt and uncle, et cetera, there's always these 2 categories. The other kind is someone that's been an operator and then exited. So my view is more of the operator / exited type of viewpoint when it comes to these types of things, right? So as long as I know that, I could help operate the business, or as long as I know that our VC fund has a deep enough bench, kind of like entrepreneurs in residence, I feel comfortable removing the CEO as needed. So the board structure I would prefer is a 2-to-1 type of ratio. In terms of vesting, I really appreciate the creativity on that, and I could see the rationale behind that. I don't mind having it revest. I don't mind having acceleration clauses in the case of an exit, and I don't mind even sweetening the offer if the founders hit certain revenue and EBITDA milestones to offer stock options as a bonus. So some of the term sheets I've seen, the stock option pool, some of it's even reserved for the co-founders, not just the employees and key hires, to sweeten the offer. So that's, some of the things that you guys could think about. Scroll down a little bit. Liquidation preference, generally it's about 2x right now in the market from what I understand, unless things have significantly changed in the past 2 years. I remember for DealFlix, like we got 1.5x and we were so proud we negotiated 1.5x. It was like a big deal for us because all our cohort members got 2x, and we kept it a secret because we were able to get 1.5x. But as an entrepreneur, this is kind of make or break, right? Because unless you have a 10x exit, which you do, but there's a lot of startups who only have like a 5x exit, or even just like an acqui-hire situation. This could leave you in a situation if it's like 2 or 3x liquidation preference, where you basically make no money whatsoever. So as an entrepreneur, you really want to argue for this. And as Puya was mentioning, and I think also Lai mentioned this too, when you mentioned the 3x preference, you want to be rewarded for the risk that you take, right? So this is something that you would normally fight for pretty heavily. This could make or break term sheets actually. So this is a big thing, similar to the board seat. This is where the battles are usually fought. Dividends, this is not a big deal for VC. It is a bigger deal for PE though, because you're going for like a 5x return, not like a 100x return. So dividends have pretty good ROI for PE, but it's negligible in the VC space. Anti-dilution, this is something that probably isn't common nowadays. I'm not sure if it ever was. Keyman clause, this is good. Conditions to closing, this could vary. It might be something like in the PE world, you need X amount of cash, you need X amount of net working capital, or you need to provide all your contracts if you're a VC. Like, did you actually close out that deal? Do you go through a due diligence check, right, to see if the code is not all like jacked up, right? So there's all different conditions to closing. Right of first offer definitely makes sense. Co-sale agreement. Did everyone consider a drag along clause or put a drag along clause in here by any chance? No? Does anyone remember what that is? Okay, so basically a drag along clause is, let's say Lai went out into the market and raised money, right? From his aunts and uncles and stuff like that. And then he has an overzealous aunt who thinks Lai is going to be the next billionaire, right? And she's like, no matter what, I am not selling my shares. And then Google comes along and offers like $2 billion. And then because she came in so early, she owns like 25% of the company. And Lai's like, and all his investors like Sequoia and Andreessen comes along, and they're like, dude, Lai, like, Google wants all of this, and your aunt is holding up the deal because she thinks you're worth like 200 billion, but Google's only offering 2 billion according to her, right? So in that scenario, a drag along clause, what it does is that it subdues, right, that person's rights to be, lesser than the preferred shares of the board. So it has the power to override that. So this could happen with someone's like rich uncle, aunt, or something like less tech, less savvier investors. To prevent that, you'll put in some kind of like a drag along clause. It's kind of like the opposite of co-sale agreement, if you will. So it's either called tag along or drag along clause, which is something that you could consider to bake in. Other key terms, good. No shop agreement, that's good. Great. Any questions, anyone? Good. Okay. Well, yeah, Ahmad, let's. Great job, guys. Let's give them a round of applause. Okay.
Can I have a question? Yes. Can I ask a question?
Yeah.
Yeah. So for a board structure, you said you want like the majority, but we are investing 25%. Can we actually have the majority with just investing 25%?
That's a very, very good question. Yes. And the reason why you want to do that, right, is because oftentimes when you're in the VC space, you have a lot of first-time entrepreneurs. And then maybe, like, especially in your case, maybe your term sheet, right, was significantly more generous than the other counter offer, Logan and Vince's offer, right? In that case, I would say something like, yeah, we'll give you 18 million valuation, exactly what you want, but we want 2 board seats instead of 1. And this is a great strategy to hedge yourself. Another thing to realize is that in the startup space, we'll talk about this a little bit later. It's very, very important to concentrate your power oftentimes into one co-founder, because VCs will try to structure it to kind of almost like split you, because they know that this is a high risk, high return type of game. So they'll try to get more board seats. So try to get control, like liquidation preferences and all that stuff. So it is not uncommon to concentrate the power into just the CEO. So DealFlex, that structure, I had only 15% because I was the chief of business development, and then the CEO Sean had 52%, which later became problematic because he wasn't pulling his 52%. He wasn't pulling his weight, right? But at the same time, this is a way that investors would hedge. So I don't know if you guys, are familiar with certain corporate governance structures in like Asia, but some companies will have like 5% and then they'll have like a super board or, super majority control of the board. And then they'll like still have like ownership of a bunch of companies. So that's kind of a sneaky way to do it. And there's all these stuff that you can kind of bake in, right? To make, to get yourself in a position of control without owning a lot of shares. Thanks. Cool. Great job, guys. Hopefully this exercise helped you guys think on both sides. So let's take a 9-minute break. Let's reconvene at 7:10, and then we're gonna wrap up some additional thoughts on the term and the term sheets, and then we'll discuss the videos, which were homework assignments from last night or last week. Awesome. Alrighty. Okay, let's get started here. Okay, so we'll just touch upon a few more topics to round this out. Um, so can anyone explain, phantom stock options? So we're all good on like vesting and cliff now, right? And everyone understands that. Okay, cool. Employee pool and its importance, we get that. I guess like let's just double check here. Like, what is a problem if what could be a problem if you don't have vesting and cliff? So let's say, Luke, Persia, and Vince, you guys go out and start a startup, everyone gets 33.33%. And then Vince says, like, man, screw this. I want to start my own startup after like, 4 months. But there's no vesting and cliff. Like, what's problematic about that? If there's no vesting and cliff, does Vince still hold 33% of the company? Yes or no?
No. Wait, if there is no vesting, then I do.
Exactly, right? So if you have a lot of employees and there's no vesting and cliff, and then Vince just decides to like leave, right? And then Persia decides to leave after like another 2 months. Luke's stuck with the startup where he owns 33%, and then the rest of his co-founders no longer are involved, right? So vesting and cliff is very, very important. Also, when you guys are joining a startup, right? If you guys are looking for jobs, like make sure you really understand this clause, because you might get certain offers, right? Especially if you start going to middle management or vice president levels, where sometimes the vesting schedule might tilt. So for example, like maybe your first 2 years, it's not really a lot of equity, but everything else is very, very back heavy. So just similar to what Puya was saying, it could accelerate after like, month 25 or something like that. Right now, I have a friend who's working at Long-Term Stock Exchange, LTSE, the one where they raised 70 million with Andreessen as their lead, and they're on a 10-year vesting schedule, so it's kind of ridiculous. So he's like in year 5, it's like, man, I'm like, I'm not gonna wait another 5 years to get this vest. I'm looking for another job, and unfortunately, most of the vesting was front end heavy still, so it's very long tail. So the structure is also negotiable as well. So don't think this is never non-negotiable if you're joining an up and coming startup. Phantom stock option pool. Does anyone know what this is? Yes.
It's when the company gives cash payment depending on how well their stock do instead of actual stock.
Yeah, and why would a company do this? Like,
It motivates the employees without diluting the percentage.
yeah, this is actually pretty common in private equity now. Phantom stock option pool. So you guys remember, like in PE, right? Your chances of a successful exit is about 55% versus something like 7 or 8% in the VC world. So in theory, it's arguable that the stock option might be a little bit worth more, but PE investors know that a lot of these companies are a little bit more antiquated. The employees are not really sophisticated and are not used to getting stock options, right? So basically, instead, they just tie it into a stock option bonus, where they get a certain amount of cash if the company is able to hit certain revenue or EBITDA or growth expectations or certain milestones, and they just distribute it at the end of the year, or they tie it in lump sum and then you get it, after 4 years or during, in the process of an exit. So those are, very, very important terms to understand. Okay, so why is it importance of the board of the directors? We get that. Why is it important to have one person hold more power than the others when it comes to co-founder? So we talked about this a little bit, but yeah, so I'll just kind of elaborate. Basically, when a company is growing very rapidly in the startup phase, Now, there's pros and cons, right? So if you're starting a company with two other friends, it's hard to debate whether who is actually supposed to get the most equity. But normally the person with the idea will hold, the largest chunk of equity possible. And then the second in the command and third in command would kind of like maybe have like 5 to 10% lower each to even it out. But what happens is that like as you get more and more and more and more investors, a lot of these investors are looking for control. So it is not atypical for investors to look for companies in particular that have a really well-rounded and well thought out cap table. So if your cap table is like really messy and there's no strategy behind it, that in itself could be a turnoff for certain investors. So that's one of the strategies that is pretty common in Silicon Valley to concentrate the shares for one or two co-founders to make sure there's a strong foundation for the founders. In terms of like the board of directors, it's typical to actually have like you're not going to give away board seats away until your Series A round, and this is typically not until a lead investor comes in. Does anyone remember what a lead investor is?
Investor who has the majority of investment.
Not Yeah, majority of that particular round, right? So if you're raising 5 million, someone who's probably putting down 2.5 or more, or who actually investing the most amount. So it is customary in the Silicon Valley world to have, a lead investor just be the one that puts down the most amount of money down. So anyone want to take a stab at it, how it works in the private equity world in terms of board seats? If you have like a group of LPs, limited partners that are interested in co-investing. It's the same thing. It's a trick question. So whoever invests the most, it's customary to ask them, right? Would you like to take a board seat? It's not necessarily the case, but it's somewhat implied. So in my case, I have one investor that has 10%, while as everyone has 6.66%. So the rest of the group, it could be anyone getting that second board seat. Okay, so what did the book mention when they said that a VC says that is non-negotiable? So remember, in the book, right? It mentioned something like, if a VC says something is non-negotiable, what does it really mean? Does anyone remember? So it usually means that like someone is probably a novice, right? So this would happen a lot with your associates and like VPs, or maybe like an intern from a VC firm. They'll probably say this is standardized, right? Or this is how it's done. This is how it's always done. But as you're able to get deeper and deeper into the rounds, like don't hesitate to question certain terms, right? So one example was, like I mentioned earlier, even though we were first-time entrepreneurs, we were able to get 1.5x liquidity preference because we didn't think 2x was fair and we thought it was too much. So just by questioning that and then just asking investors and other entrepreneurs who were able to get 1.5x liquidity preference, we were able to get that. So anything is negotiable, right? So you're upset about the stock options, ask for a better valuation. You don't like giving away board control, well, why not go for the anti-dilution clause? So it's always negotiable. So one of the things that I like to do is that if there's like a really long term sheet, I would argue for things that I don't really care about. So by the time there's points where like I really care about, the investor, or like, even if I'm doing sales, the counterparty is so exhausted. They're like, all right, well, this is going on for 3 hours. I'll just give you this term here. So it's not atypical to do that. Additionally, like I'll have my other co-founders decide on who's going to be the good cop versus the bad cop, so that we intentionally like constantly like throw them off. So that's always been like a strategy of mine. And negotiations, like guys, like it sounds intimidating, right? It's like, oh, how do I, negotiate with an investor, or like how do I negotiate with the banker? But if you just have fun with it and you just make them feel uncomfortable, you're usually in a good shape. Like I like to say that if you go into a meeting, right, and if you don't know who's the wolf and who's the sheep, you're probably the sheep, right? So as long as you're aware you're the sheep, you're probably in you're in a good situation. But sometimes you go to a meeting and you feel like you can't read the other side. It's probably you're probably the prey, not the predator. That's a good rule of thumb. And I do often go to these meetings where whether it's an investor or a seller, they just don't have enough self-awareness on who's holding the cards. But as long as you're in a situation you understand that, generally you're in a good situation. Why do PE firms love dividends while VCs don't care? I think we covered this, right? PE firms, they're more about short-term residual stuff like that. Examples of conditions precedent to financing. So this is just usually in the term sheet, right? Part of the no shop clause, oftentimes, basically talking about is there enough working capital, or are they receiving enough accounts receivables? Are the Q1 financials as good as it seems? Once it's audited, right, then we can proceed with it. Another negotiation point is founders' activities, right? So, they make it very, very strict that you should only work on your startup. So in the book, they say, they not only want 100% of your time dedicated to running your startup, but basically 120% of your time. That is certainly true. But in my case, for example, I was able to get an exemption, right? So for my PE fund, I basically said, hey, I want to teach at Chapman University. And my explanation was that this is additive to what I'm doing, because if I'm talking to bankers or I'm talking to potential sellers, I could present myself as a higher status person, right? So if you're able to kind of explain certain value adds, like don't be hesitant to be able to explain that, and you should be in a good situation. Okay. Any questions on any more term sheets? Are we good? So you guys are all experts on term sheets now? Okay, it's good enough. Okay. So advice on fundraising. Did everyone get a chance to watch the video? It's pretty helpful. Okay. So delay working with VCs as long as possible. What was the messaging behind that?
Basically, you want to know how much, you need to know the business well enough to know how much you want to raise. And so if you don't have it figured out, it might not be best to go find the VC, because they're just gonna laugh at you.
Yeah. Any other thoughts? So I bump into this a lot, whether it's, a Chapman student or, a U Chicago friend, they give me this elaborate business plan and they're like, hey, I need funding. So you want to, like, VCs want to see some traction, your ability to get stuff done prior to providing, money. So they want action biased people, entrepreneurs that are go-getters. So if you're just coming up with a business plan and you're like, hey, fund me, like the VC will normally be like, dude, get the heck out of here. Like, I don't know how you operate at all whatsoever, right? So why would they just kind of give you $1 million? So you want to build a relationship. So one of the things that we actually did, right, is so in my class, or not my class, for the interns that I'm managing, I tell them to dream as big as possible, right? So I gave them an opportunity to make at least 0.1% of stock options, which, on a 20 million acquisition is like 20 grand, right? If you can get me a billionaire investor in our cap table, like I will give you at least 0.1% of stock options. right? And I gave them a template to start reaching out. So this is an example. So there's this kid, Joshua, he goes to Columbia, smart kid. And I told him like, dude, look into your alumni group. Columbia, is pretty good school when it comes to finance, and find alums that are potentially billionaires, right? So he reached out to 10 billionaires, and then one of them replied, Carlo Agostinelli. They're from a PE firm called Roan Group. Are you guys familiar with Roan Group? So they have $8 billion assets under management, and his dad's a legend. So the dad told his son to reach out. The son's a kid at Stanford, trying to do his own like VC fund, right? Branch out from his family. So we just had a meeting with them like today, right? And they were so impressed with the audacity of this like 19, 20-year-old just reaching out and saying like, hey, I'd like to have a meeting with you. And then they're like, wait, what is the purpose of this meeting? Like, do you need money? Like, we're like, no. Like, do you have any deals ready to go? Like, no. But instead, what we did is we showed them our deal sheet. Like, hey, these are all the companies that we're looking at. These are the prices and the ranges that we want, and these are the numbers that they have. So we prepared like an anonymized deal sheet that we decided to create, and we allow any of our investors and potential investors to access this Google Doc at any point to see what is going on internally with our company. Like, what deals are we looking at? Deals that we killed, interesting deals. What's the ask price? What's the revenue? What are the notes? What's the reason that we killed these deals? This is a live document that any investor can have access to. So it goes out to about 200 and something individuals. Even though we only have 22 investors, we created this just in case we wanted to get more investors. So we got the emails of Elon Musk, Peter Thiel, Mark Cuban, and it's like, dude, if there's a deal that you like and we don't like it, I'm just gonna give it to you. Like, Elon, you need something for SpaceX, like robotics. Like, I mean, there's a robotics company that I don't even understand what's going on, right? So this type of open relationship kind of matures into something much bigger. I've realized from my experience. What I'm noticing is that like a lot of entrepreneurs, they do a very poor job of building relationships. But the point of that example is to kind of showcase to you guys, it's not necessarily one and done. You knock on someone's door and like, hey, give me some money, right? So let's say, for example, that guy from Roan Group, right? Carlo Agostinelli, like he keeps reading my emails like, month 1, month 2, month 3, right? And for me, like I actually really enjoy writing. So what I'll do is that with me and my team, I'll just create these kind of like, kind of semi-blog like investor updates, which are not really long relative to everyone else's. And investors, if it's like a day or two late, they start emailing me like, hey, where's the update? Like, did you like cross me out? Like, what's going on? Like, it's kind of cool to build that relationship. Because I do have a very, like, they like to say like confident writing style. And they look forward to this, right? So I've noticed the best entrepreneurs who are really good at that, and the ones that raise money in just 2 weeks, they're able to build that. And it's not even, and if it's like, and if you're not even looking to do a startup and raise money, it doesn't matter, because you might reach a point where your, lifestyle business might start accelerating, right? And if you want to raise capital, if you already have those relationships built in, it's kind of like, oh, dude, I already know you. I've been reading your investor notes for 2 years now. I'd love to invest. So that like relationship building is really, really important. The other one was like, okay, what are the clear convictions needed, right? What are you going to do and the amount that you need? Why was this important when reaching out to investors? Anyone?
Sorry, could you ask the question one more time? I apologize.
So in the video, you know, one of the founding partners of Techstars mentioned that, you know, the two things that you need to be clear about is, you know, what are you going to do and the amount of money that you need. Why do you think that is important?
Because you want to define the terms, not have the investors define them.
Not necessarily, but that's a good one. You definitely want to have the terms and understand where the money is going to be allocated. But in startup land, oftentimes it's really, it looks really, really bad when founders don't have any kind of traction and their idea is still in the beta stage and it's still like very squiggly, right? They don't know what value that they're adding to the customer or their client. So for that, like, you want to be very clear, right, on how you're building the company, which direction it's going. So that's, you know, one of the things that you have to really understand. Importance of mentors and advisors. So what's a really good idea? Like, for example, right, if you're launching a startup, let's say, you know, let's say like you're trying to launch the next Facebook, right, social media app. What are some good ways to reach out to, I guess, like what kind of people do you want to reach out to as mentors and advisors if you're trying to create like Facebook 3.0? Probably people who have worked at Facebook before, right? So one of the strategies that you can use for this particular case is that you want to reach out to founders who also failed at launching that particular business. So I've noticed a lot of people, you know, want to start the next e-commerce business, right? They think they have a great idea, right? Or they want to build, let's say, the next, you know, Uber, the next Groupon, or next, you know, whatever type of company. I guarantee you, any idea that you come up with, there's a list of similar companies that try your idea and failed at some point. I guarantee you that. And what bothers me sometimes is that, like, I preach to my students and then as well as my friends who want to start startup ideas, try to Google these people and reach out to them and ask them like why they failed to get product market fit or start building traction. And sometimes they might have pivoted and exited and did really well. And sometimes they just became discouraged and decided to travel the world or whatever, right? But the knowledge that you can attain from people who failed at growing their startups is just insanely incredible. That's a surefire way to know if your idea is viable or not. So I remember when we first started Dealflix, there was Chimflix, exact same company. There's My Movie Deals, there's Movie Mongoose, there's Project X, there's like 10 different companies, maybe not 10, at least 5 or 6 different companies. And MoviePass was just starting at that time too. There are very similar companies that had the idea. So fast forward like 5 years later, when Dealflix was still around, I actually had a chance to talk to Chimflix, which was like almost the exact same company, but in the East Coast because we were in the West Coast. And I talked to them and I was like, well, why did you guys give up? Or why did you guys basically fail? But in a nicer tone. And I was so surprised that his answer was that we talked to like several movie theaters and they said no, and they just gave up, right? So for that, it wasn't a product market fit issue. It was just the founders not having enough willpower, right, to just want to take that business to the next level. So there's all these hints and nuggets that you could drop. And then once you have usually one mentor or one advisor, they're probably going to introduce you to that social group. And getting a mentor is free. Just be like, well, what's it take for me to be your mentor? Well, yeah, just like 30-minute Zoom call, like once a quarter, you know. And people will do that. You know, I know a couple of my friends, like, you know, they did that really well. They just started reaching out to people randomly, and you know, some of them just have mentors now because they kind of bake that into their practice in terms of professional development. A great way is build commonalities. with mentors and advisors. School is a good commonality. Just tracking their LinkedIn and social media profile. Certain volunteer groups. One good way to actually network is to go to volunteer events, because sometimes these people who are doing really well, they'll have their own organizations for charity. And to show up at one of these events is much more helpful than going to a professional networking event where you're kind of showing your cards and saying like, hey guys, I need funding, or hey guys, like, look at me, look at my idea. So the subtlety.
Late stage seed, pre-series A, and then it goes kind of Series A, Series B, Series C, all the way up until they stop raising money. Like Uber's got like, they're up to like Series Z before the IPO. And then there's either IPO or exit.
Wait,
And people
hold
are
on.
investing in a way of buying a company, it's either a change of control or a whole thing, or it gets public. And if you go public, and then that's an exit, and then it still gets bought. So like Microsoft might buy a publicly traded company, after it's listed on a big exchange. You also have real
All right,
exchange.
one
You go out on like a crypto
second. I
exchange,
gotta
you go out on
find
the
out
TMX in Toronto, or
where's
ASX
the
in Australia,
sound
or
coming
in
from.
London.
I don't know how that happened. Sorry. But that was Andrew Roman's video. So I usually watch videos at like 2 to 3x speed, by the way. So what was I saying? Totally lost my train of thought. Can't remember. Does anyone remember what I was saying?
You were mentioning how you could go to volunteer events because they're really good. People have their own charity fund.
Yeah. So it's a very subtle way of networking. The goal of the entrepreneur is not to raise VC funding. So there's a lot of vanity in Silicon Valley where it's like, oh, I raised 100 million or I raised 200 million. It's not how much you raise, it's really the exit price. So a lot of entrepreneurs, like they get suckered into this trap, and it's easy to, get, really high off your own Kool-Aid, thinking like, oh my God, I'm so cool. All my friends only raised 10 million. I raised $100 million. I'm a badass. But it's not really your valuation. It's really your exit price. And these tech startups are just so, I guess, like so quick in terms of its growth. Like you could just completely miss your exit just by playing, just serendipitously. So you shouldn't put too much emphasis on that. What's the problem of raising at a valuation that's too high versus too low? What are some pros and cons? Let's start with raising at a valuation that's too high.
You'll have to pay back probably even more than you even borrowed, than you actually needed.
Oh, based on the liquidity preference?
Yes.
Potentially, but it's not debt. You don't necessarily pay it back, but it is restrictive because of the liquidity preference clause. What else?
It increased the expectation of the business. So when you have like high valuation, you expect from founders to grow faster, more. Yeah, so basically the expectations will be more than what is your actual ability.
Yeah, perfect. So the pros are basically the higher the valuation, the less you'll be diluted, right? So each Series A, Series B, Series C, you're going to get diluted by 30%. But if you make the valuation really, really high, you're not going to get diluted so much because the investors with that, let's say it's same $10 million that they would put in 50 at a $50 million valuation versus 100, you're diluted 50% less, right? So while that is really, really good, the problem is if you're too expensive, right, you're going to turn off a lot of investors. And if you don't meet the expectations and the market crashes, you're freaking screwed because now your valuation is way too high compared to a market that's not as hot as it was, let's say, a year ago. So you could pretty much be in a situation where you're raising money at a down round, which is a lower valuation, which would signal negativity to the investors. And as we talked about earlier, investors are quite sheep-like. They'll follow, right, whoever is the lead investor oftentimes. So this could put you in a really bad situation. Vice versa, raising at a lower valuation will give you, a lot of options, right? But then you'll get significantly more diluted. So imagine if you raise $10 million at a 20 million pre, right? You're already going to get 30%, 33% diluted. So you have to really consider those pros and cons. That's why building relationships with investors is key, because if you're raising money when you're running out of money, that's the worst time to raise money. Has anyone heard the term or the saying where you want to raise money when you don't need it? Basically, that's what you want to do. So that was probably one of the failures that happened with one of my prior companies, Cinemia, when MoviePass went bankrupt, and then we were doing really well when Andreessen and Sequoia, some of these guys were knocking on our door. Even Goldman Sachs was like, "Hey, we want to, build a relationship with you guys now." I kept telling the team, like, "Guys, you need to raise money when you don't need it." And then when they needed it, no one wanted to fund them because we were stuck in a bad situation. So that's one of the things that you have to be very conscious of. Okay, so this is just a really funny example. So this was just a very, very thoughtful email, right? I'm not sure. Can you guys read the screen here? So a potential seller talks about, "Hey, I hope all is well. You initially emailed me late May, and now the timing may be better for us to schedule a phone call." Then he goes on and talks about, we also provide 24/7, blah, blah, blah. And then we have 4 companies that have knocked on our door for potential acquisition recently. These range from ad tech companies, agency training, one client. Blah. So he's flexing a little bit, right? I get it, right? And then I mentioned, wait a second here. Oops. And then I actually thanks a ton. I wouldn't get too high off of a few inquiries that I told another seller. Even my niece's lemonade stand is getting offers in this market. We solely focus on our. And then he replies, "I really appreciate your candid response and being open to the phone developing relationships." Oh wait, let me see here. I wait. So I replied, "Thanks, Phil," and then I replied here the lemonade comment. And then he started flexing again. And then he says, "Hey, Kevin, appreciate the candid feedback and talk soon." So the question is, why did I neg him? Basically, why did I have to, I guess, what was my strategy behind that? I wanted to ask you guys.
I guess take him down a notch doesn't make him think he's all that. So when you negotiate, you have the upper hand.
Yeah, basically, yeah. I'm not doing this to feed my ego. The problem is, if let's say you're an entrepreneur and you sent this email, you already got the meeting. There was no reason to go back and flex. Like the meeting was already booked, right? And then he flexed one more time. And for me, it's like, I want to know about your product and what you do. And then if the conversation leaves off of that, the next meeting that I have, he's just going to talk about all the offers he has and how great his all his opportunities are, right? So for me, it was so important to kick him down a notch and bring him back to earth. I'm like, dude, I don't care what other offers that you have. Like, you're still a tiny company. So you want to be in a situation, where you're leveraging, but you don't want to be in a position where you're flexing to a point where you put off an investor. So this could have gone both ways, but you as an entrepreneur and you as a investor, right? You want to try to be able to really understand and finesse these types of situations. And this was just kind of a really quick example of what happened recently. So I'll post this on the slide deck. Let's talk about Andrew Roman's video real quick? So what was Andrew's approach in terms of like investing? I know it's like only like 8 people. Yeah. Yeah, so basically, do you guys remember when Andrew talked about, you know, how it's so much better to invest in the private sector than the public sector, and his reasoning why? Puya, you're nodding your head. Can you help us here?
Yeah, so basically he was saying that the risk of public market is more than private market. So it was his approach. He was saying that if you invest like less than 10% of your total budget in each like VC firms, and even if half of them go bankrupt, with the return that you will get from the other half, you will have a positive return compared to the public market, basically the stock market. And
Oh yeah,
yeah.
good. And why did he talk about the Gordon Gekko example from Wall Street?
It's all vague. I'm thinking, yeah.
Does anyone else remember? Oh. Logan, were you trying to say something? No? Okay. So basically, if you're a VC, right, and then one of your startups is about to get a huge contract, let's say with Disney, really big company, you'll have that insider knowledge, right? And then you can act upon it and invest more money into it, right? But if you are publicly traded, if you do that, that's illegal because it's insider trading. So his investment thesis is like, why would you want to invest, right, in public companies when you have access to all this private information in the private markets? He also touched upon the fact that, you know, because fewer and fewer companies are going public, there's less companies in the whole entire ecosystem. So you have these huge surges in like the Teslas and the Zooms and Twilios and all these tech companies, because so many investors are just like concentrating their wealth in just a few companies, which was very different from 20 years ago. So those are just, you know, very, very interesting viewpoints. You know, and there was another point that Romans talked about, you know, why you know, that, you know, every company is going to be a tech company, and it doesn't make any, well, I guess in his viewpoint, right, it doesn't make any sense to pursue anything outside of tech. But, you know, I mean, you know, it really depends on what you want to do, you know, with your career. But his thesis was like, every company is going to be a tech company, so why not, you know, go ahead and build a career in tech. So that was his viewpoint. Any other tidbits that you guys want to discuss about Andrew Roman's video? Nope. Okay, his view on blockchain was really, really good. He actually was a speaker for the blockchain event 2 months ago, and he's definitely, you know, really, really smart. So if you haven't had a chance, please watch the video. It's a pretty good perception on how, you know, VCs view the world, because I think he's very opinionated and he has a very strong viewpoint. He also has a approach where he only wants to invest in founders that he knows. So he doesn't invest in founders that just send cold emails. And a lot of VCs are actually like that. So he'll talk more about his philosophy if you get a chance to watch his video. So with that said, you know, today's class is a wrap. We're going to end a little bit early today. We're actually a little bit ahead of schedule in terms of where we're at. We actually caught up quite a bit. I'll stick around if you guys have any questions. And for those of you guys who joined us a little bit later today, we'll also have a little bit of a midterm review session tomorrow. So, you know, if you have any questions, feel free to, I guess, like prepare the questions ahead of time so we can discuss them during the lecture. Great. And yeah, hope you guys have a great Friday.
Thank you very much. The recording
Thank you.
available in the Canvas?
Yeah, all the recordings should be there. You guys have access to all of that, right?
Yeah.
Yeah, it goes to like a YouTube link.
Thank you very much. Have a good one.
Thanks, Professor. Have a good Friday.
See you tomorrow.
Thank you, Professor.
Thank
Thank you.
you. See you tomorrow.